are involved in putting together the lunchbox session. So we're really excited to have Nigel here from Taupo Young today to talk about the current economy. It's a pretty hot topic at the moment, and I particularly am looking forward to finding out.
A very small part of it.
I want to know some.
Don't ask about your house.
Welcome, and this will go for half an hour, and there'll be some questions at the end. If you do need to go to the bathroom during this session, the bathrooms are go out of here and go into the kitchen and hard right. If there's a fire or some kind of emergency, we're going to go either out the exit that we came in, down the stairs, not the elevator, or there is a second exit behind me here. But just follow me and we'll be all good. Is anyone hot or cold? Because I can change the aircon before we get going, and that's about it. And I think, do you want it to be pretty, like, put your hands up and ask questions and make it interactive?
Can be. I've got a slot at the end that says questions,
cool.
But if you've got something that sounds particularly pertinent or you think will confuse me, you're welcome.
Test them out. No, cool.
But yeah. We'll see how we go.
Cool, and we are being live streamed at the moment, so Nigel is going to parrot the questions back. Cool.
Okay. Am I on? Can you hear me? Yeah, cool. I don't normally have a problem actually conversing this side of a room. Okay, simple stuff first. Nigel Kenny, Taupo Young Valuers. Just give you an update. Taupo Young is what was Robeson's. 2000 we formed part of the Taupo Young Federation. For want of a better description, that was about 11 offices and probably 30-40 people. 17 years later, it's now 17 offices, another 5 sub-offices, and with 100 valuers, it's by some measures the largest valuation practice in New Zealand. Still the same people, still doing the same job, just different colour. Joined Taupo Young in 2002, so 15 years working for Taupo Young in Whangarei, and prior to that I was the commercial manager at Cootes Milburn since '95, before that, and then I was in London. So I have been here a little while and have picked up 1 or 2 little things. I also, by the way, am on the New Zealand Institute of Valuers Council and their professional practice committee, which actually is their disciplinary arm. So I do like to hear about valuers, particularly if they're doing something good, but also quite used to them when they're not. First point, this one. And I will deny everything later. Moving on slightly. It was Eddie from Russell Turner who originally sort of asked me, could you give us an update on the commercial property market? And I sort of summarised it by being, basically, so you want to know what's hot, what's not, and what to stay away from? He said, perfect, that'll do us lovely. Well, schoolboy humour and thinking I was just presenting to accountants, I thought, well, that's going to be a great invitation for loads of soft porn. But in the more enlightened era, I thought we'd do something a bit more topical and say what's hot, what's not. And what to stay away from. Okay, right, back from personal bias into personal opinion. In order to actually understand what's driving the commercial property market in Whangarei, you've got to understand what drives property in general. No matter how you crunch it, at the end of the day, property is nothing more than a capitalisation of cash flow or potential cash flow. If someone's paying rent, it's worth something. If someone will pay rent, it's worth something. If no one's ever going to give you any kind of return on it, it's a liability. So, first and foremost, the most important part of the whole exercise is tenants. The rental market. It doesn't take 3 degrees and 20 years of working through Whangarei to take a walk through the streets and have a look at a huge amount of empty shops. And if you give up trying to trip over the broken pavings and look up, you'll see a huge amount of empty offices. This is not Whangarei's problem, it is a global problem. We have a vast amount of obsolete space. Retailing has basically moved from ma and pa around the corner to big box. That's a good third half of the trade today. Some of you probably got better figures than that, but the other thing that's happened is everything's gone online, and a third of all our retailing now is internet. No surprises. The repercussions are we have secondary shops, tertiary shops empty everywhere. They're not going to get, they're never going to have a serious tenant probably from here on in. Beyond that, even our prime stuff is looking weak. You walk through Cameron Street and down John Street, and you see something in John Street, it's empty, nobody gets bothered. I walk through the Cameron Street Mall and see three prime shops empty. That is not a good look. They won't be empty forever, they will let up, that's why they're prime. But at the moment, weak. I won't talk about the volume of empty offices because I depress people too much anyway. Same scenario, you look through Whangarei and you see State Insurance, you see NZI, you see National Mutual, all the insurance companies that used to occupy most of our space. Well, all that's left is the names in people's memory. There's virtually no major establishment from any of those companies left. Internet again, what used to be 100 people working is now one computer algorithm. Walton Plaza, 50% of that used to be IRD. They've now got 2,000 square metres on Bank Street, and even that, I don't know for how much longer. Just the nature of where it is. The usual fallback option of new companies moving in just isn't happening. They're computer and tech heavy, not people heavy, but we can work on that. The other factor, just a minor one, is that, and I wrote this thinking there'd be mostly accountants here. 10 years ago, most of you sat in a 25 square metre office, so you could swing the cat with gay abandon. Nowadays, we're in cubicles where your neighbour's got to breathe in order for you to stand up. So density of population within the existing space due to intensive space planning has really shrunk the thing as well. I mean, government's got a requirement to shrink the government footprint by 10% per annum, unachievable target. It's about like recidivist offenders, but it was up there and they were certainly moving to do it. Okay, so on that happy note, before you all jump off the first balcony, what is also happening is an old Bob Jones thing where the cost of replication of a property vastly exceeds its market value, you will get rent rises. So in Whangarei, if you want something decent, people are prepared to pay for it. Not ridiculously all the time, but give you some brief examples. Westpac building, Ministry of Social Development required a minimum 1,200 metre floor plate. That is achievable in Whangarei, but to get a performance standard out of a building on a 1,200 metre floor plate, not easy. They gutted out the 3 tenants on the first floor, single tenant space, 1,200 metres, nice new ceiling, carpets, modest partitioning. Not a screamingly high rent, but compared to obsolete B-grade space, pretty good. Thomson Wilson needed a decent address. They were one of the first off the ranks, and they got themselves a brand new building. Not a high profile location, but really, really nice space. And when you do the adjustments on it, she's up there. That little building on the right hand side is the Whangarei Police Station. It's got some of the nicest offices in Whangarei now. And the cells are quite nice to stay in as well. It's a backpack operation. But again, that one, originally it was going to be solicitors, they've sublet and it's just moving through that. But very nice, very well presented. It's the equivalent of what Whangarei would call A grade. The one thing which I haven't mentioned so far is industrial. At the moment, Whangarei Industrial is doing quite well. reasoning being, I suppose, people starting up, one guy, two guys can take on a small workshop. Much, much easier than trying to get $500,000 turnover to justify a shop. Same answer. If you need the space, you will pay either a rent that pays a return, or you will pay to build a new building. So what we've actually curiously got here, all these three just happen to be beside each other, which made life convenient. Specialist truck maintenance. Specialist truck maintenance, that's actually a distribution company, but there was nothing in Whangarei that actually came anywhere close to the standard they were looking for. So it isn't all bad. The good is getting better, the bad is getting worse. Okay, so moving on to the fun stuff, where the money's being made, maybe.
The space thing per employee and that, is there no regulations?
There are industry standards.
Yeah.
And it's just, I mean, it must meet some performance standard, but it just seems everyone's getting smaller and smaller. And certainly it's a better use of space, but it's getting a bit hot in some of those premises, which is why high performance air conditioning and lighting is now becoming really, really important. I mean, a lot of the growth we've had, I mean, that MSD building, if you walk in there, is literally desk, separating board, desk. And that's a lot of people in a very small space.
Health and safety aspects, people off sick, all that sort of stuff, you jam not too much.
So I know I worked at the idea when they moved into Auckland Plaza, and that stage their standard was 8 square metres per employee.
Yeah, and it's getting smaller. I mean, you just sit there and you think about it, you're getting something half times the size of your desk, which is now a workstation. And that's actually smaller than my desk used to be. So, it's all right. I live in the basement of our offices, which means I don't have to share with anybody. That little sign says doesn't play well with others. Quickly looking onto, as I said, the investment market. I said earlier, tenant demand is weak. We've got an awful lot of supply. Now, on the basis that property value is money comes in, you look at the security, you look at the time frame, you go capitalisation rate, there's the value. If we've got no tenants, none of them are committing for very long, it doesn't sound very good from an investment perspective, and yet we have seen dramatic increases in commercial property over recent years. The reason is that everyone will be probably quite familiar with it because you're all paying mortgages. We have got persistent long-term cost of finance and at the moment significant availability of finance. When you sit here and you look at, say, 5% loan, you gear that on a property, the returns you're going to get in a commercial property with a decent gearing are quite good. They will beat, and someone can contradict me, but they'll beat any security or bank deposit. The catch, of course, is they could fall over tomorrow and you could lose most of it. Never going to lose all of it the way of, say, secondary finance companies, but there is more security there. So what basically the market has been hunting has been good modern low liability buildings with good tenancies and someone who you think will pay the rent and carry on paying it. So you sort of look at what's gone through fairly recently. This was, I think, just before Christmas. It looks like a specialist building, which to the amateurs stay away from. They're dangerous unless you understand them. That one, the catches, well, the market rent may well have been a little bit on the high side. The real catch, the tenant owns the fit out inside, and the chances of actually getting any rental growth out of that is debatable, might change, but you sort of look at it and go, oh, I'll give them 5 or 6 years, we've got to get something, and then you've got 3 years left in your lease and you piss your tenant off Not likely they're going to go, but it won't be an easy one to get any growth out of it. And at 6%, your margin between your finance cost and your return is not exactly huge. Basically an Auckland investment group that got quite carried away because they were looking at 3.5% in Auckland. We had 3 buyers on that. Not one of them got to put a bid in. So that's the answer to that one. But very nice, very clean, very tidy, and in many respects precisely what the market wants. Okay, that's not such a good photograph. Again, 4.7 years, not great, not bad, 6.67%. I look at this and go, oh, post office, who are losing, 10% of turnover per annum? What's going to happen in 5 years, don't know. And also design of the building, not ideal for alternative use. Offices out the front. We're in a road that's heading towards bulk retail. Future use, who knows? People are dying to buy that. And that's not exactly overly positive. Okay, very recent one. Slightly different. 3 years, which would not normally meet the strong investment criteria. Yield of 7%, but sold to a guy who knows what he's doing. The rent isn't high. 3 years' time, he will get an increase if the tenant stays, and if he doesn't, the guy knows the market well enough to be able to work it through. So slightly different to the normal. This is an older one, sitting up there, top end of Whangarei. Farmlands basically wanted to vastly expand their network, built loads of these things around the country, put a building specification on it, which was terrific, but probably well above what they needed. Built costs were so high, they sold them all off on a sale and leaseback at some pretty stonking great rents. 7.3% would probably do better today with a 12-year lease. A lot of guys buying this stuff are sitting there saying, there's my pension fund, in 12 years do I care? It'll be the grandchildren's problem. So they've got their money and they're not going to fall over. But rental growth, which basically keeps you ahead of inflation, not likely. This really proves what happens when you offer absolute guarantees. Ruakaka has, I can't remember the figure, 40 hectares of industrial land ready to rock tomorrow. Virtually nobody down there. This is 7,000 square metres of industrial buildings. Not something you can trade easily. But that's sold at 7% because, and that by the way with quite a high rent relative to market, 15-year lease, direct to who are substantial people guarantees, independent bank guarantee, and an equity requirement that there's something like never less than $3 million cash in the company. The building you would not touch, which you just bought, is a financial security secured against the property. And that's why it's 7%. So it's that security that drives everything. Okay, oh, and that's a local one, which is household name, a collection of buildings of modest quality, but a 10-year lease, 7% again. That's the sort of, if you've got good tenant, good security, you got the deal. Okay. Thank you, Monty Python. I needed that line. So what happens when you take away the good building, you take away the tenant security, and you take away all hope? This is actually a really good little spot. It's just down the road there. For many, many years, that was state insurance. It's just off the Cameron Street Mall. It was maintained to a good standard by state. There's a new roof on it, and there's a couple of $1 million of a building just being built. In fact, it's about 4 million just being built here. They bought it for just over $1 million, based upon the last rent that was being paid, a 9.5% return. But it's been sitting empty for a year and a half. So, not looking good. If the tenant had stayed and carried on paying that rent, that would have sold for 7%. Now, the landlord had it on the market at $2 million a year and a half ago. So if it's empty, it ain't pretty. This ain't pretty. This is never pretty. The only reason this one's in here is you see 430. Now, on a better market, but it's sold more. That, I'm afraid to say, is what we call a small investment today. You either buy a rental house or you start looking at low-level commercial. And when you get into comparing it with the return on a house, return with a commercial building, the margin that people will accept means that they'll pay some quite strong figures for smaller commercial properties. That had a rubbish cash flow. It's probably got a weighted average lease term, which is like the average of all your tenancies in there, of about a month. So you've got virtually no guarantee of cash flow. The building is a hodgepodge of bits glued together and pretty much local tenants. So 10.4. They were lucky. This is actually another very good building. Has had a variety of tenants in it for the last couple of years. I think when I first saw it, it was Boys Real Estate, who are long gone. Rutherford Reed had new ceilings, new partitioning, new carpet, you name it, it was new, it was nice. And I think Melville and Ellis went in there after them. Last time I was involved, the rent was about 50,000, so that might be back a little bit now. Just sold to an owner-occupier who's gone in there auctioning second-hand goods. Very good move for them. Very nice return for them, and if the road ever recovers, could be very nice indeed. But it was empty and nobody wanted it. And the piece de resistance. This is a very, very prominent building in the middle of Whangarei. I first got involved in this about 20 years ago. After Michael Hill had started to vacate significantly, they split it into floors. Floor downstairs was quite easy to get rid of. About 96, 97, the top 3 floors were sold to an investor who immediately flicked off the first floor, which was leased. And that left him with 2 floors of about 900 square metres above that. Now, over that period, they have refurbished suites to order. So there are maybe half a dozen suites in there which are cleaned up and quite presentable, and then there are bits next door to it, which is the old bare concrete columns, thermoplastic tiles, no ceilings. They couldn't in nearly 20 years get tenants into that building of significance. Its primary problem is it has absolutely no car park with it. Other than that, there's not a hell of a lot that can't be salvaged. But nobody went there. And after, I mean, admittedly, the owner has been critically ill for 3, 4, 5 years. The widow basically had enough of it. At the time of sale, the income coming in did not cover the rates and insurance. So my analysis is ignoring trying to let it in a derelict state. 750's what I would call a good clean-up. It'll get you some sort of ceiling, decent wiring, decent lighting, basic level air conditioning. Nothing fancy, nothing crazy, but then the 280,000 a year rent isn't exactly crazy either. You put those into the equation and the purchase of that could be seeing a 17% return if they can pull it off. But you've got to pull off a tenant for 1,800 square metres without a single car park. The previous tenants of that used to rent in the basement of the IRD. But still, to this day, the available car parking to accommodation is inadequate and it's not there. Car park value is very much dependent on the ratio of car parks to the floor area of the office and how close it is. The MD will pay $100 a week for a car park if it's beside his office. The staff might disagree. But so that basically shows you, If it's good, it's good. If it's bad, it's getting worse. Okay, so comes to the punchline, and the answer I've got is haven't a clue. An awful lot of property is technical. A lot of it is number crunching. A lot of it is working cash flows. And a lot of it is sentiment. How good do you feel about something? We've currently got ongoing war in Syria, just to name one. Potential nuclear war in Korea. And even if that doesn't come off, because I doubt Trump could get it right, we've got Trump to deal with going forward. We've got Brexit to go on. Then we've got global instability. This should really be crippling the global economy. We've got rumours of interest rate rises in America. Well, frankly, not overly bothered. Because at the end of the day, we're still going to be better than everyone else. We've just got to get everyone to remember that. We're being told interest rates are static, and what they're advertising is, until you go for a loan. And the answer coming through at the moment, which is really important, is the word no. Not terms, conditions, whatever. There are people out there being told, no, we don't want to lend you money. No apparent reason other than policy. It seems to be driven to a degree by a hydraulicking of effective interest rates. So if everything's perfect and you get 5%, the guy who's 90% perfect who'll pay 6 is a better person to lend to. But that's just that's very much personal opinion. We've had about 4 deals in Whangarei in the last 3 months where I think that would be an argument to actually say what's actually happened. We're not going to see a vast change in demand for retail. We're not going to see a vast change in the demand for offices. There will be more demand for the real quality stuff, but even that doesn't go quickly. That MSD tenancy took better part of 2 years to broker. And the landlord's fit out was fairly significant. We've got to start looking at some property as alternative. I mean, when you look at some of the real C-grade retail, wander up to Maori or Kaikoui, Hikarangi, there are people living in those units. Do it right, they're not bad. And they're cheap. The only problem is you're paying commercial rates. You see some empty offices. Virtually every empty office building we've got floating around, someone's got a drawing out there to convert to apartments. At the moment, the cost of conversion is unlikely to cover, the value is unlikely to cover the cost of conversion, even just build works, never mind the actual intrinsic value of the offices. However, if you appreciate the offices might be worth nothing because it's going to take 20 years to let, it might be a slightly different ball game. A lot of people have got a lot of historical investment in property, but there's going to need to be some changes to mindsets. I mean, a lot of this think smarter, work smarter sort of thing, but we need, my view, very much my view is, if we start intensifying the residential occupation within town, it serves a number of purposes. One, it gets rid of an embarrassing amount of offices. We start having people live in town, then there are more people who will casually shop. The bars will get casual visitors. I don't go out in town anymore. Too frightened, too old. But if I was living closer down and could walk, then a lot more normal people might be out of town, and that's a self-fulfilling dream. We then have a vibrant night time. So, anyone wants to move to town? Good idea. Other than that, not a lot going on that I can really sort of say. We have got that new ASB building hitting the market in probably 6 months. It's already floating, but I think they will be marketing it. I would expect that to do slightly worse than it would do today. Not desperately, because as I said, I think we're pretty much going to be same for a while. There will be instances where there will be serious damage to some properties, but everything is on its own merits. But in general, the quality stuff will just slide on or slide down slightly. I don't expect tragedy. But what we're not going to see, in my view, is the Auckland 3.5%, 4.5% yields. We do not have the demand from tenants. We do not have the long-term demand that gives you security. So ultimately, here all you've got is the goodness of the lease that you're buying. So, I said I have a question.
Just in the sense of the new ASB building then, and you made mention of attachment of parking to
Yeah, that has got parking.
It has got parking.
Yeah, there's 6 or 8 spaces out the back. You go down the side lane and they come in off the side and off the back. Not an awful lot, and if you consider what they've got over on Walton Street at the moment, that's a significant reduction in parking. But we're not sure, one, that they're going to close Walton Street for definite, in which case it become academic because the one across the road's got no parking. But I don't think it's going to be customer, which is be interesting. I mean, the banks haven't worked very well for customers over recent times. And if you happen to live in Carmo, you'll know exactly what I mean. Convenience, parking, customer friendly, hasn't really come across very much from the banking sector. It's a little hard to do with someone who says, sorry, I know we're making loads of money, but we want to make more. And that seems to be the storyline that's coming through.
It's the question though, why you would build a building in the middle of town. Why would you go and put it?
18% IEP is a start-off. One of the drivers for a lot of new buildings, not up here because we're not a high-risk area, but Christchurch, for 40,000 in Christchurch or whatever it was, Wellington falling apart. The powers that be are concerned about seismic strengthening. They are very, very concerned about the impact of earthquake, and there is a corporate responsibility to put staff into compliant buildings, even where there is no risk. I mean, sorry, take that back. Low risk is the Northern definition. But the existing ASB bank had a very, very low rating. So to maintain some kind of customer service, across the road was probably it. But as I said, it could well be that another year or two, it's the last ASB bank in town. Don't know. They have threatened to walk, I believe, on their other one, but that's owned by somebody now who I don't work for very often. So we'll have to wait and see on that. But I mean, also begs the question, as a reference to the post office earlier, is it a good investment? Well, they're going to be paying the rent. You know they're good for the money. They're going to be paying it for a 10-year lease. But Carmo became obsolete, Whangarei became obsolete, Walton Street may become obsolete. In 10 years' time, is a bank investment good? Then you start looking at the relativity of the actual cash flow compared to the market, and you've got to say to yourself, why are you paying $550 a metre and the shop next door is paying $250? Because when they walk out, it's what the market will pay, not what the contract is. And that is with a lot of those better quality investments. I mean, we analyse it, but a lot of people don't see it. And that is the contract rent to market may be quite separate. But some of them are good, some of them bad, one of them is even low. Most of the time, sale and leasebacks, which has been capital raising by a lot of companies, you don't pitch your rent low because you've only got one opportunity to sell the building. So it's expensive finance in some respects, but it's capital that may not be available otherwise. So yeah, they're always worth a very careful look at.
I've seen a lot of development over the years and also in recent years down Port Road
Yep.
and out that area out there.
Mm.
What's driving that? Is that likely to continue?
There's actually a very, very happy set of circumstances driving a lot of that development. One of them relates to a very good little Whangarei company based down on corner of Hewlett and Fraser Street, which was an old engineering company for Whangarei that used to do a lot of building products. They developed themselves their own steel shed system, which actually quality-wise is up there with any of them. But they came in at a cost which beat most of the other systems. We have low finance costs, and as I said, people wanting better space, all of a sudden, well, if the rent was $80 a metre and you can rent this for $85, it's a no-brainer. And those sheds you can build on reasonable priced land, get a value which in today's market is achievable, and the whole mix works. And it's just made develop. I mean, most of the time, 10 years ago, to build a decent shed would cost you $800–900 a square metre. The investment returns at the time on something brand new would have been 9%. The land would be probably very similar to what it was today. You'd probably have to pay a rent 50% above market to justify building it. So today, investment yields really low, all your other costs really low. Built costs has dropped in some instances by 50%. It's just, it all works. And long may it continue. Because I think...
And there's been further development out through Kiora Road.
Yep. And if you look at that particular company, they have on Gumdigger Place 3 buildings they've built recently. There's 2 more on Kiora Road. I think they might have done one of the Rewa Road buildings. They've certainly got a couple down Port Road. But I mean, that's now I think a 10-11 franchise national development company with, I think they told me the other day, a turnover of 250 million on final contract price.
Yeah.
And that's working out of Whangarei. So that's one of the really, really good things in the background. Not.
Even redeveloping the old freezing works.
Yes, although trying to make a silk purse out of a sow's ear is a little hard. I'm waiting to see someone go up that driveway yet to the first floor accommodation. But the freezing work land was a much, much easier deal to work with. Has taken a hell of a long time. I mean, it would be 6–7 years ago that the ITM pre-cut went into the back of it. Last 2 years we've had Placemakers Farm Source and it's not Whangarei, it's the other one, Boatyard. So that's 6-acre site is now virtually fully developed. I think there's a bit of land left, but as I said, it took a long, long time before costs of doing it, returns and doing it made sense. So we're lucky at that stage at the moment. It does beg the question, I suppose, of what's happening to all the old space. But as I said, industrial at the moment, we're not too bad on. Although the Placemaker's yard where they moved from is still empty at the moment. But that's another thing. There's not a lot of appetite out there for very, very big development sites. You need that guarantee of a tenant going through to get that level of return that actually makes the land and building costs realistic. If you're doing it on spec, you need huge margin and frankly, not fundable.
Well, I just asked, is the old Countdown building likely to move anytime soon?
I will not talk about that. The marketing on that was mildly optimistic at the outset. I believe it is being relaunched. They went to tender in March to choose new marketing people on it, and I believe it'll be coming back to the market saying any realistic offer will be looked at. But I think they were at 5.5 million when they put it on the market first off, and I don't think we got anywhere near it. But it's not necessarily the building's wrong, it is the nature of the market at the moment. You walk in there with a brand new private hospital that can afford to pay 5.5 million, deal's done. But it's a big ask. I mean, there's some very good sites around Whangarei that are worth an awful lot more than you can get for them today. So they're being sat on. But they will...
Have they got rid of the asbestos in the roof then?
Yes. Yeah, I think I saw the start of that probably 3-4 years ago. They were taking out the worst of it then. Whether it's completely cleared is another matter altogether. You never know until you put a chemist in. But yeah, I think that's... But I mean, truthfully, that building's a bulldozer. It's 1960 shed, plus a bit, plus a bit, plus a bit, plus a bit. And that's actually made it virtually impossible to do anything else with it. So yeah, she's... it could do so much, but unless you've got an end user, yeah, it's would make a really good supermarket actually.
I'm thinking about, I've been thinking quite a while about the city centre needing to change the so we live in apartments.
Yeah.
And I guess it's zoned retail commercial.
It's not the zoning that's really the problem. You can change zoning. What you've got is the owners of the buildings would actually say some fairly draconian building regulations like means of escape, fire escapes, stuff like that. You know, like the cuddly, touchy, feely stuff at the end that really isn't necessary. The outdoor play areas, well, you need someone to move the boundaries and a lot of that stuff. I mean, that Michael Hill building, there was a chap there a year or so back was looking at the idea of turning it into student accommodation. Very, very small, self-contained units, very, very high density, backed up with common area type services. And I thought that was the best thing that you could do. Very little demand for cars. Great, because you ain't got none. Awful lot of people spending money in the centre of the town, roaming the streets at night. I thought absolutely brilliant. Catch, a building that is leased to 200 students paying you weekly rents is very, very different to an investment where you have the local university paying you $500,000 a year, which is actually less than the 200 students. But they're on a lease for 10 years or something like that, paying you rent. That I can bankroll. A 200 flats student hostel on weekly rents would be very, very hard.
It would be a different thing, but would the council be difficult? Would they, is anybody applying?
I think somebody talked, and I don't know that I heard any progress. There was a hiccup in that one of the driving people behind that actually got somewhat sick and hasn't come back to work again, and the money behind and the client who was really behind him, I don't know the detail, but that was the market rumour. And as for the Chinese guys who own it now, no idea. So it's, but it was a good use for the building. But I said, I'm very keen on getting more people living back in Whangarei. I mean, even if you don't buy into the end of the cheap oil argument, to all those lifestyle block owners out there, it's just nice to get the redundancy out of it, and it will get more life into it. And even just talking to a client there this morning, they've just moved from the suburbs into town, and their entire business is actually feeling more vibrant because they're not out in the sticks anymore. So.
Yeah, I'm with you. People in town would be there.
Mm.
Particularly that more niche shops then as well.
Yeah, because that's the future for these small ones. Boutique candle shops.
Yeah.
But you need a lot of people because I don't buy that many candles. Cafes, bars, great. In fact, I think it was it Pam Peters who came up with a great idea to actually bulldoze out all of John Street, James Street, Dent Street and put a town basin extension into it. So we had waterfront cafes. I thought it was a great idea. I don't think the people who owned the property did, but I thought it had some serious merit. Last question, anyone? You've got to go back to work now.
Better end it there, but thank you guys so much for coming, and this is a little
Oh,
something from us.
lunch.
Nigel, to thank you
you.
for volunteering your time today and presenting to us. So, yeah, thank you again for coming, and if you haven't been here before to the orchard, then feel free to hang about and go for a wander to check out the space. And working for Northland Inc., we're definitely pushing the business community growth, and we would love to see the CBD full of new businesses as well. So I think that's all of our responsibility really as a community, so let's do it. But thank you again for coming in, and I'll see you guys in 3 weeks for the next session.
Yeah, cheers. Now.